One of the things that we decide, thank you. One of the things we decided to do in order to encourage homeownership, knowing that we were an area of affordable homes, we decided to put together this homeowner information series, an education series, covering some basic topics for people who are looking to buy their first home. So when he comes on, we have two presenters actually tonight, Cindy Theory, who will start. She is a realtor with Laura McCarthy. She lives here in University City. Hi, Bill.
Hello.
She lives here in University City, the real supporter of University City in terms of home ownership. And the other guest speaker for tonight is Bill Bruce, who has joined us. Bill was in the mortgage lending business for about 40 years and retired, and was enticed back into the business through Enterprise Bank and Trust. And so he's a senior VP over mortgage lending. And I would venture to say that when he re-entered the mortgage lending field, it looked very differently than what it did when he left. We know what's happening with interest rates all across the board, what's happening with the Fed raising rates, inflation, etc. So I can't think of two topics that are of more importance right now to, especially to first-time home buyers, than the two that he's going to cover today, which is credit repair and what is out there for first-time home buying assistance. So Bill, take it away. Now, Cindy, do you want to go first?
No, let's let Bill go first. And if Mike could just please advance the slides.
Okay, fantastic. Bill, welcome.
Thank you. Thank you very much. Appreciate the opportunity, Mimi and Cindy and Mr. Reed and everybody give the opportunity to talk about it and everything. I'm going to cover tonight just kind of the overall, start with credit, and then we'll talk about down payment assistance. But I think that if we go to the first slide as far as what credit is and why it's important, if you can go to the next slide, Mimi.
Yeah.
Okay.
Okay.
So obviously people know what credit is as far as ability to borrow money and pay it back. It's a good thing. It's a good financial tool. The thing I really want to stress tonight, though, as far as we're talking about mortgages and buying a home ownership and what have you, but credit's important not just for buying a house, but also for other items such as your insurance. And some employers now are looking at credit scores before they will hire somebody. So credit is much more than, hey, I don't worry about my credit because I'm not buying a house or I don't need a car. It's going to affect all impacts of your life, and it's going to continue to go from there. Next screen, there's the cost of credit. We have three things here as far as the principal, interest, and fees. So the principal is the dollar amount that you borrow. The interest is what the lender is going to make by lending you that money as far as the payback. So if you borrow $100,000, you're going to pay back more than $100,000, depending on what your interest rate is going to be, depending on the term of your mortgage, depending on the term of your automobile loan. But understand that it's not just what you borrow. You're going to be paying excess over and above the principal amount. And on a mortgage, you're going to have some fees as far as origination fees, credit report fees, things along those lines. But make sure you're dealing with a lender that's disclosing all this to you up front. It can't be a situation where we'll talk about it later. Make sure you have it all up front before you sign on the dotted line. There are two different types of credit, secured and unsecured. Secured means that it's going to be backed by an item. It could be your house, could be your car, it could be CDs, some type of security, but there's collateral there. In fact, that if you do default on the loan, the lender has something to fall back on. He's got something in hand that he can use in case of a default. The unsecured debt is going to be a credit card or a line of credit, things of that nature. Obviously, if you've got a secured loan, you're going to be much more interest rate positive in that respect. An unsecured loan, you're not going to have that ability to do that. You're going to have a little bit higher interest rate. So next one's fine. Yeah, lines of credit, as far as your borrowing money as you need it. Interest rates could be fluctuate. It's a variable rate. So you have to be cautious about that as far as what the limit is, what the ceiling is on the loan. So if you get any kind of variable rate loan, if it's a home equity loan or a credit card loan, make sure that it is not going to be one that's going to increase. On a term or a mortgage loan or installment loan, it's going to be set for a specific line. And that payment is going to be set and it cannot change. It's going to be fixed for a certain period of time. And that's usually on a car loan or a mortgage loan. Sometimes there's lines of credit where you have the ability to borrow, but you have to pay it off each month. That's called an open line of credit. On your credit history, which is the next slide, credit history is made up of your credit cards, your loans, your mortgages, your medical bills, utility bills, and other non-lending expenses. Could be rental or something of that nature. The utility bills and rental are something new that's added to the credit reports. In the past, they were not reported, but you can self-report those if you don't, and we'll talk a little bit about building your credit. If you want to self-report those items, there's a way to add that to your credit report. If there's adverse actions that you've gone through as far as a judgment or a bankruptcy, or there's other liens, such as past taxes or things along those lines, those will all show up on your credit report also. So it's going to show you the good and the bad. When you have a bankruptcy, it's going to last on your report for 10 years now. They're going to keep that on there for a 10-year period of time. If there's a judgment, it's a 7-year period of time. So if you do have that difficulty running into credit because of a loss of a job or a medical issue, know that that's going to be on there for a period of time. You can still acquire a mortgage or get financing on an FHA, as an example, 2 years after your discharge date. So it's not like, oh, I filed bankruptcy, I can't do anything about it. If the 2 years has expired and you've established good credit, you still will be qualified to do it. On a conventional loan, it's 4 years after you file and then it is discharged. You can do that. So credit reporting is typically from 3 different sources: Experian, Equifax, and TransUnion. I'm sure you've heard about these in the news before, and Equifax, as far as the kind of the problems that they had in the past where somebody hacked into their system. But typically a lender will pull from all 3 bureaus. And what they will do is they will throw out the high score, throw out the low score, and they will use your middle score. So if you say, oh, I got 760 from Experian, but your TransUnion is 560, but your Equifax is 680, that's the one they're going to use for credit lending purposes. So it's the middle score that you're going to be concerned about. The next slide will show kind of the breakdown as far as how your score is made up. And the biggest you can see there as far as your payment history. Do you pay your bills on time? That is obviously constitutes how your score is determined. The amount of money you owe, 30%, the next item there. How long you have credit? Have you established a history of it? It's like, well, I just went out last week and opened it up. I've only made one payment on it. It's not going to help your score in that respect. What's happened here? We good?
Mike, we lost the slides.
Yeah, okay.
Let's see what's going on.
Let me see if I can pop them up and share my screen. Give me just a second.
Bill, while she's working on that, how would I have? Okay, how would I get a different score at the 3 different credit reporting agencies?
There is, and one of the slides allows everybody is entitled to three scores once a year, a free credit report. And there's a website that you can go to, and it's a free. Bureaus must provide you 1 annual report, and that will provide all 3 of your scores for you. And it breaks it down for Experian, Equifax, and TransUnion.
Do they use different criteria that they might come up with different?
Yep, they do use different criteria. One has a FICO, one has a Beacon. It's different models that they use.
Okay.
Some of them put different emphasis on these different items that we're talking about, be it your payment history. Inquiries are a big factor, the number of inquiries. If you're shopping for a mortgage or if you're shopping for a car loan and you deal with 2 or 3 different lenders to get kind of what your interest rates and make sure that you're getting the best possible program out there, that's not going to affect your score because they can tell you're a prudent consumer and you're doing your diligence. And if you do those within a 30 to 45 day period of time. But if you're constantly looking for new credit cards and there's a lot of inquiries on your credit report, that's going to draw down your scores. So you don't want to have a lot of credit card companies running credit reports. You go to the ball game and, oh, we'll give you a free blanket if we can run your credit report for you. You want to stay away from those things. You go to Macy's and, oh, open up a credit report and we do it that way. So that's going to make an impact. Good job, Cindy.
Okay, all right. And somebody said, do they use the app, that middle score for, if there's a range, do they use the middle score
They
generally?
use the middle score. Yes,
Okay.
ma'am. It's always the middle score. That's the one that they throw out the high and throw out the low. And it's
Got
the
it.
middle score that's going to be used.
Okay, all
And
right.
Bill, do you want to speak to mortgage credit scores versus credit scores you might get with an online credit app?
Yes, that's how I was at the bottom of this screen here, coming up a little bit. You'll see the range, and thanks for asking that question. It gets into the next level here and everything. So on a mortgage score, we pull from all three. It's what they call a tri-merge. Sometimes if you're looking for a credit card or you want to get a line of credit, they may just pull one score. A lot of people have Discover cards and they get a score on there, our Credit Karma. Those are not really the scores that a mortgage lender is going to use. Our report is much more in depth. And as far as these items that are listed on here, it's going to your history, the inquiries, and it gives us much more information. And if one is a little bit negative and one could be a little bit positive, that's why they use the middle score in that respect. So these ranges that we show on here from 3 to 600 and then from 620 to 679 and 680 to 730. If you're in that 680 to 730 range, you're in pretty good shape as far as getting a mortgage. Not that you couldn't in the fair range, but it's going to be impacting your credits. Your credit's going to impact your interest rate. So in the past, when somebody said, "What's your interest rate?" Well, I'm 7% today. Today, if you've got a 740 credit score, you're going to get a better interest rate than somebody that's got a 660 credit score. So mortgages are a little bit more attuned to the score when it comes to interest rates in that respect. And the other comment I'd like to make on this, that you'll see FHA lenders sometimes advertise, "Oh, we'll go to 580, or FHA will go to 580 for a credit score." Most loans, if not all loans, mortgage loans are sold in what they call the secondary market. And I'm sure you've all heard of Fannie Mae and Freddie Mac who buy these mortgages. And they have various investors that sell these loans to them. And those investors will not buy the mortgage at a 580 score. You may shop around and go across the country, may find somebody out there, but most lenders won't go as low as 580. Even though FHA says, "Hey, we'll go that low," it's tough to find a lender that would go that low from an investor standpoint. So you want to try to get in that 680, 730 range. You don't have to be great, but if you're good, you're going to get a good rate from that standpoint.
Bruce, just a quick thing. My house is now paid for, but I think over the course of it's like 22 years to pay it off. My mortgage was probably sold or changed lending companies probably 3 to 4 times. Is that normal? Are they freeing up money or offloading?
What's happening is that a lot of the mortgage business is obviously, you can tell, cyclical. 3 years ago, rates were 2%. Everybody wanted to jump in the mortgage business and everything, want to hire people and things along those lines. Now rates are 7.5%. Nobody wants to be in the mortgage business. So what happens is these banks, they buy these portfolio loans, and then they can't generate new loans for the sell-off, for the refinancers, the loans run off, so to speak. They have to keep that up as an asset. And if there's not that volume of new mortgage loan applications, they say, "Hey, we're out of it. We're out of the business altogether." GMAC had a mortgage lending arm that was fantastic. They were very easy to work with. They had good interest rates, but they just kind of looked at it and they said, "This is not the business we're in." So what happens, Mimi, is they sell that whole portfolio. We're out of it altogether, and they sell it to somebody else. So we try to deal with people that don't sell, that they're going to keep it a one-time type of situation. And we tell that to everybody, but GMAC was one of our big ones. And you think, well, GMAC is going to be in business forever, but guess what? You know, the mortgage business is a little bit different. So they kind of got out of it. So that's usually what happens. Some lenders just kind of turn them and they just kind of buy them and they'll turn them all around. So you have to be a little cautious of that. So when you talk to your lender, ask them who they're going to sell it to, who do they deal with, who are their investors. And if it's names that you've heard of, a Wells Fargo or Chase or something along those lines, then you can feel pretty comfortable with them in that respect.
Thanks, Bill. I have a question in regards to VA loan and credit. Is that something different, or can you speak to that a little bit?
VA is going to be consistent with what we're talking about here today, as far as these numbers, as far as the 680 to 730. So if you're a veteran, without getting to specific programs, that is far and away the best program that is out there that's available to anybody, any buyers in that respect. It's 100% financing. So all you have to worry about is your closing costs. You don't have to worry about on an FHA where it's 3.5%. They'll do 100% on a VA loan, but they still look at these same credit score criteria, and their income qualification is a little bit more liberal too. Most lenders on conventional FHA loans, they have two ratios. They have a housing expense ratio and they have a total indebtedness ratio, which is your housing expense plus long-term debt, meaning car loans, revolving charges you don't pay off, things along those lines, where the VA just says, we don't care about the housing debt. What's your overall ratio? And they're pretty liberal in that respect. So that's a very good program if you're a veteran. That's the one I strongly encourage you to utilize.
Thank you, Bill.
No problem. Warning signs. These are things to look out for when you have credit issues and everything. If you're at your maximum limits, you're only paying your minimum payments each month and everything. Or if you've had good credit for a while and all of a sudden somebody's turned you down, there's something out there that you don't know about. You know, you got to find out about that right away as soon as possible. And obviously, if you defaulted on a payment, on a car payment or a rent payment, that's going to cause some issues. So be cognizant of these things as you pay your bills on a monthly basis. So to keep a good building credit rating, as far as you go through this and everything, most loans are a 30-day late cycling period. So as long as you pay within 30 days, you're in good shape. You have a problem and everything. This next item is really, I think, very, very important and critical. A lot of people don't mention it or be cognizant of it. And I've had this cause a lot of problems for people over the years. They've had a bankruptcy. We're working with them. We're kind of repairing their credit. We're at the 2-year mark. They've reestablished their credit, and something happens, and they miss their car payment. And when they apply for loans the month before, and because they missed that payment, and it's within the last 30 or 60 days, I've seen scores drop as much as 40 to 50 points. The bankruptcy, you know, that's obviously factored in. It brings your score down, but it had nowhere the impact of a recent late payment on a mortgage, or not on a mortgage, but on any type of debt that you have. So you want to be very cautious that once you get to that point when you're ready to buy and you got your credit established, even if you had past credit problems and you reestablish it and you're going forward and things along those lines, you want to make sure you don't make any late pays in that period of time. And the ways to do that is at the bottom here. You want to save your interest payments, manage your credit, keep your ratio balances as far as credit balance, the credit limit as well. That's another factor that's going to affect your score. I'm sorry. It's going to affect your score. If you've got a credit card with a $5,000 limit and you're carrying a balance of $4,500, that's going to have a negative impact on your score. Whereas if you've got a $5,000 limit on your credit, on your credit card, and you're carrying a $1,000 balance, that's going to help your credit score because it shows how you manage your credit in that respect. And if you're able to pay them off each month, you want to pay off the entire payment each month. The example I like to use here, and I've had people, do it over the years. If you order a pizza, say you buy a pizza delivery and it's $10 for the pizza, and you say, well, I'll just put that on my credit card. And each month you don't pay off your credit card, and then you're paying it off with a 15-16% rate of interest, and it takes you 12 months to pay it off. That pizza is going to cost you $37. So you don't think about that when you spend that $10 for the pizza. If you don't pay it off in a reasonable period of time, that's what it's going to cost you if we keep carrying that balance over a 12, 15-month period of time. So this is 30% credit limits that I was talking about. It's $5,000, $1,500 limit, things along those lines. We talked about keeping your inquiries low. You don't want to open up a lot of accounts. Don't apply for multiples at or near the same period. This is the only time that I would say that this is okay. Like if you're applying for a mortgage or a car, call a couple different lenders, make sure you're getting a good rate and it's a good possible deal. That will not impact your score. Have a lot of borrowers, we call and say, well, I want to get pre-qualified. Well, unless you have a credit report, you can't pre-qualify. Well, I don't want you to run my credit. Well, if I don't run your credit, I'm not going to know what your score is and everything. I can give you an idea, but I can't run it from that standpoint. So as long as you do it in that 36-day period of time, it's not going to affect your scores from that standpoint. Next one, Cindy. It's kind of what we're going over for as far as using the card for only purchase what you can afford, pay it off each month, apply for the cards that you need, apply for a mixture of credit cards and loans. So you've got that mixture on your credit history if you have no history. So this kind of helps you establish your credit. If you have never had any credit, that is a detriment. Nobody's going to lend you money if you don't have a credit score, which is kind of tough to understand. But say, well, you haven't demonstrated that you have the ability to run a credit report, to obtain a credit report, to run credit and everything. So we want you to go out and get a credit card, and we can do that Enterprise, set you up credit cards, things of that nature. And obviously, there's other lenders that do that, but that's a good way to start. Reports are now have opened up what they call tele-reporting. If you pay utilities on time, or if you've got a rent history and you've got a landlord who's agreeable, they will contact them, and that can be used to build your score. In the past, those were not things that impacted the score. The thing to be cautious about on this, the one that I did have one lady was tele-reporting, but her payment, she had bought a phone. She wanted me to use my cell phone, and I'm going to use that on my tele-reporting. Well, it's $480 for the phone. So when I pulled the credit report, her monthly payment was $480 a month. Well, obviously that was a one-time charge. That was not her monthly payment on her cell phone bill. So we had to go back and get that corrected because the 480 was throwing her ratios out of the range of approval. So when you do something like that, make sure you're reporting not what you're spending at that time, but what you're going to pay for from each period and everything. So then you're going to get into things called non-traditional credit, which is rent payments, utility bills, things of that nature would help out, and that will establish your credit for you. So everybody knows that, hey, I want to do this. I'm cognizant I want to do that and everything, but you're going to have some problems from time to time. If, you have a job loss, something that you can't control, company shuts down, things of that nature, medical expenses, they're not going to have and everything. The thing that we ask people to do is communicate this as quickly as possible. Don't say, well, I'm going to find another job. I'm going to get it work, especially if you had a good score and everything, you want to go down. So communicate with the creditors as soon as possible and sometimes they'll work out a plan with you if they understand what your employment situation is or what your credit situation is from that standpoint. So don't kind of run and hide. You want to address those issues from that standpoint. So we're going to follow the same steps as far as when you build your credit. Once we've got it established, open a credit card, department store, specialty store, work out with your creditors, get agreements in writing, pay that, maybe show that you've showed your proof and payment. If it's kind of got beyond you and everything, where you're at the point, well, I need some counseling on this. I don't know how I got to this point. I didn't really realize I was in this situation. And we have a lot of buyers that, that comes up that we run their credit report and they say, well, that was my ex-husband. He was supposed to do that, or I got divorced and I'm no longer on that loan. If you get divorced and your decree says that one of the spouses is responsible for it, that's fine per the decree. But as far as the lender, who the creditor is, they may not release you from that debt. So I've had situations where we pulled somebody's credit, they've been divorced for 2 years, and the spouse who was supposed to make payments never made the payment, and it still shows up on your credit report because you were never released from it. So you want to make sure you get a release of liability from that standpoint. And sometimes, the attorney says, oh yeah, we're going to quit claim the property. It's out of your name. Don't worry about it. But unless that loan is refinanced, your name is still on the property. It's not on the house anymore, but it's on the mortgage. So you have to be concerned about that. And there are some agencies out there that that I would recommend. Urban League offers some really good, Urban League of Metropolitan St. Louis, some real good credit counseling. They have some real help for there if you get issues or problems along those lines. Neighborhood Works is another good organization, and Consumer Credit Counseling is a good one. So those are three. There's others out there, but those are three that I recommend. That if you get behind, if you have a situation in that respect, don't say, well, nothing I can do. There's ways to do it. And the way that we work with you in that respect is to repair that credit. So we don't want to say no, that you can't buy a mortgage. We just say not yet. And let's get you to that point where we can get you approved for that credit score that we need to get you to. When you talk to these credit bureaus or whoever, whether it's any of these people, make sure that don't pay them anything up front, with services. Make sure that, it's somebody that they're helping you with something that, they say, well, we get this resolved in a week's time. It doesn't happen in a week's time. Make sure it's somebody you feel comfortable with in that respect. And here's the question as far as reviewing your credit report. You want to check your credit report, as I said, that you can do that on an annual basis for free. There's no charges. You can check all the balances. If you go to the next screen, Cindy,
Mm-hmm.
that's the next one. So there, obtain a free credit report, www.freecreditreport.com. You go in and log on in there and everything, report once a year, and it should be available without a charge, or sometimes small charge, but the ones I've seen, they do not charge for it or anything along those lines. Thing I will caution you about, though, and this happens more and more, as good as I think these companies are, Equifax, TransUnion, I have found out that they do sell lists, like say, well, Miss Smith has applied for a mortgage with XYZ company. You might want to contact her. And all of a sudden you're getting inundated with other lenders calling saying, wait a minute, I hear your mortgage. What if we can help you? We got this rate and things along those lines. So be prepared if you get something along those lines. And I've talked to a number of bureaus about that. I've talked to some agencies, and there's nothing that can be done about that. They have that right to sell that information from that standpoint. So that does happen from time to time. So that's kind of an overview of the credit, kind of the history of how it's got and where to do it. My biggest takeaway of dealing with people with credit issues, as far as once we bring something to their attention, it's a situation where, hey, Bill, I'm going to get this. I'm going to get on it right away, and I'll get it worked out. And they're calling me every day, which is fine. I work with them and everything. If you heard back from the bureau, I paid this off, or I did this. I went down to my lender and I made it 2 payments and everything. It takes time to report these things. And my comment is always, it's kind of after the fact, but if we're diligent in the beginning before you got to this point as where you are at this point in time, we wouldn't have these problems. So be cognizant once you get a credit card, or once you get into the field of buying a credit for whatever it is, car, make sure you're making those payments on time. And obviously a lot of lenders today offer auto payment. So if you've got a checking or savings account, that's the best way to build your credit. Have the payments drawn directly from your account, so you don't have to worry about writing a check out each month in that standpoint. So that's another reason to have a good banking relationship or a credit union relationship, to get auto debit, to make sure that you've got good payments from that standpoint and a good credit history.
Bill, I know you represent a bank, but I wanted to ask you a little bit more about credit unions. Are they good at building initial credit, like a secured credit card? Or I know you did mention something like that.
Yeah,
but,
credit unions are good. I'm not going to talk to anybody that's been in business and everything. As far as out there, there's some very, very good credit unions. And to be very, very honest, Mr. Reed, I've had times where credit unions are they're in and out of the market. They've got money to invest, and their board kind of says month to month, okay, we've got surplus money. We're going to go into the mortgage business. We're going to buy mortgages, and they get very aggressive with counseling and you'll see their ads on television. They'll do a lot of things, and they're in the market and they've got very good interest rates. But then when their money dries up, they're gone. They can't do it anymore. But I've had situations, and I try to be as fair and honest with my customers as possible. They come back, and it used to be Anheuser-Busch. I think it's Together Credit Union now, the Anheuser-Busch Credit Union. It's called Together Credit Union now. And when they want to get aggressive and they want to get in the mortgage market, they get very good. And I'll tell the borrowers, hey, go to I still call it Anheuser-Busch, but it's Together Credit Union taking over. It's a better deal. I'll tell you, it's a better deal. But they do work with you in that respect. Sometimes maybe not as diligent as a bank when they work with a credit, but they do a good job.
Thank you, Bill.
Any other questions for Bill before we move on? Okay, well then, let's talk about home ownership, because if you're on this call, you most likely have an interest in home ownership. So there's kind of a big debate out there now. There's a lot of companies buying up properties to turn them into rentals. And for some people, renting may be the right course of action. There's obviously not the upkeep that you have with the home, but with home ownership, it is a source of wealth creation. And if you were on our last call, some of this is repeat, but it's worth repeating, right? The big benefit to owning a home is building that equity, and it's kind of like a forced savings plan, if you will. And so another stat that kind of, backs that up is the amount of wealth that's created, right? So, if you look at this, it says Americans had a 75% gain between 2012 and 2022. And that middle income homeowners saw their properties appreciate 68%. And so what does that translate to? The 122,000. So while you're forced to save and you're building that home equity, at the same time, your property value hopefully is rising. And in the last couple of years, property values have had a great increase. Last year, it was the largest increase in 40 years. So we had another kind of bumper year, and I'll talk about that a little bit, and the impact that interest rates and home prices have. So this is just another slide that, it shows some stats between the percentage of income needed to rent versus buy. I will say that last month, the cost of renting slowed. It was almost flat, which, during the pandemic, rents went sky high. And so, but you do hear a lot, that it's cheaper to buy than to rent. And at face value, that's not necessarily true. I talked about upkeep before. But what they mean by that is that wealth creation, in that you are saving money and by building equity, but also by increasing the value of your home. So this is an example, and due to the time, I'm not going to go into a lot of detail, but we will send these slides out. They're going to be posted on the SHED website. Some of the information that Bill mentioned earlier, I'll make sure we post there as well. There's we're building a little toolkit. So links to the Urban League, Consumer Credit, and I know, Bill, you mentioned once more, but we'll put these slides and those resources up on the SHED website. But this is just an example, right? If you pay rent over the period of time that you would pay a mortgage, and if your rent is $2,500 a month, you've paid in $900,000 toward rent. And then on the right hand of the screen, you'll see that, you can read through it there, but you're still going to give that $900,000, but you're also going to realize $285,000 in gained equity from paying off your loan. The other thing I think that sometimes is a little surprising to people when they buy a property is at closing, and Bill may want to chime in here, but at closing, you'll get a payout schedule. And your very first payment, the majority of it goes to principal. But as you get closer and closer toward the end of that 360 months, most of it's going to principal. So my point there is that sometimes I work with clients, and for whatever reason, they've bought a home and they have to sell it within the year. And I've had this just recently, a boyfriend and a girlfriend buy a house. 9 months later, they break up and they want to sell the house, and they don't understand why they're not getting all their money back that they paid, because in that 9 months, the majority of that payment was going to principal. So, it's good to think about your long range goals. I've had a couple of those situations just here very recently. And so if you purchase a home, make sure, if you're going to do it with someone who is not a spouse, that you're very sure about that. Here is kind of the timeline and the process. So I always tell my clients that, and it's not necessarily true in this market, but putting a contract on a house and getting it accepted is almost the easy part. It's getting to the actual closing that's the difficult part. So you can see that after you've selected a home, you're under contract, you have to go through inspections and appraisals. You have to do all the paperwork, and I was going to say jump through the hoops, but there are some hoops that sometimes you have to jump through when you're, getting your mortgage. And so after you get through all that, there can be obstacles, right? If there's inspections or something wrong with the house, you have to negotiate it. If the house doesn't appraise, you have to negotiate that. So there's a lot of things that can happen between the contract and actually moving into your home. But your lender and your real estate agent are there every step of the way to help you through that process. Bill, we didn't talk about interest rates, and so I threw this in at the last minute because I just wanted to talk about this a little bit. So I pulled this just on a quick internet search today to show you where the interest rates are versus the annual percentage rate. And so if you look right here, he talked about FHA, where you can put 3.5% down. Is at 7.5. Now, as Bill mentioned, depending upon your credit score and background, that can vary. I know I have someone closing next week. They're at about a 7, and they're with a VA loan. So that would make sense because they're right there.
Right.
But I don't know, Bill, if you want to say anything about interest rates.
Yeah, I think these are pretty representative of the market. Obviously, the thing to acknowledge that rates, change not on a daily basis, but can change on an hourly basis and what have you. And this APR, as it says at the bottom, they're going to talking about the fees that the lenders charge. So somebody may have the same rate or maybe even a lower rate, but they're going to charge you what's called points or discounts, which buys down the rate for you, but it's a higher cost from you. So when you look at your mortgage application and say, well, not what the interest rate, but as Cindy has up here, also what's the APR, because the rate could be attractive. Well, everybody else is quoting, 7, and this one says 6.25. I'm going to go with this one, but then you find out the APR is maybe as high as 8 because there's discount points involved. So you got to make sure that all the fees are excuse me, are homogeneous with each other. So this is a good example here, Cindy.
Yeah. And then the other thing I wanted to talk about rates, and Bill might want to share his opinion on this. But when you hear in the market right now, and how I try and counsel my clients is because some people need a home right now. For some people, they may be more flexible in their timing. One of the things that's driving up the cost of homes right now is the lack of inventory. And so why is there a lack of inventory? And that means there just aren't a lot of people out there selling their house. And part of it is due to the interest rate. And if someone got a loan a few years back, they probably have a really great interest rate. I know mine's 2.7, so I'm
Wow.
happy. I'm happy with that, right?
Right.
So I'm not going to go out and sell my house and have to buy another one at 7.5. And that's why there's this lack of housing inventory to buy. Now, some people are saying that maybe by the end of the year or the beginning of next year, interest rates are going to dip back down, maybe get into the high fives, maybe mid fives. That's, no one has a crystal ball, but that's kind of what the experts are saying. So if that happens, not only will you be able to purchase more house for your money because you're going to be paying a lower interest rate, so you can put more money toward, the cost of a house, but also there are going to be more homes. People, that are at the 4 or 5% interest rate are going to be more comfortable selling their home and going out and getting a new mortgage. So that's going to open up more inventory, and there'll be less competition and maybe not as crazy of a market as we've seen the last couple of summers. We've talked about this before, and again, this will be on the SHUD website, but there are some home buyer programs to help first-time home buyers. And I shouldn't say first-time home buyers, but it's how you define a first-time home buyer. So, with Missouri Housing Development Commission, their programs, I know that if you're a divorced woman, you are considered a first-time home buyer. If you haven't owned a home, I believe in 3 years.
3 years, right? Yeah,
3 years, right?
If
You
you have
are
not owned
considered-
in previous 3 years, you're considered a first-time home buyer. That's correct.
Right. So it's important to understand like where you fit in to the different programs and learn what is available out there. There are some like with the MHDC, I mentioned the Missouri Housing, their first place loan and their next step. One is a first-time home buyer program, one is not. But I have a client who was selling a place in Lafayette Square, and the buyer, because of its location, was able to get a loan for 3.5% when the going rate was 6.5%. So there are all kinds of different programs, from low interest rate to down payment programs. And so it's important to understand what programs are available out there. So, well, that was kind of good timing. It's right at the top of the hour. I went through that very quickly because I know we had some technical difficulties at the beginning, but I am always here to answer any questions that you have about real estate. I know Bill is available to answer your questions about mortgages and lending. And so we'll just open the floor back up for questions.
Well, Cindy, it's two questions I have. One, is there any kind of central clearinghouse on home buying assistance programs that people can go to? And because if I deal primarily with one financial institution, and I have for years, that's where I'm going to go.
Okay.
First step, if I'm looking for a home loan. And I hear they offer some kind of a home buying assistance program. How do I know that's the best one? Can I shop around at other financial institutions and say, hey, what are you offering? Or do I go online and Google, first time home buying assistance programs? How do I do that? How do I know that what my financial institution is offering me is the best thing that I can get.
Yeah, so I would say yes to all of that. So when you speak to your lender, and Bill can speak to this, right? He's been in the business a long time. Bill's going to be very educated. And so it really comes down, and you know, as a realtor, I am learning things all the time. I'm learning things from my clients' lenders. I have lenders that just come to me and say, hey, that's how I learned about the low interest rate program. A lender came to me and said, hey, did you know your listing is eligible for a low interest rate? I didn't know that. So there is a lot out there.
Right.
I try to educate myself as much as I can. That's why I think what Shed is doing is so awesome, and that we're trying to build that toolkit. Other websites that I would go to look at are FHA and Fannie Mae or the VA. They have a lot of tools on their websites as well, and we have links to them on Shed, I believe, as well. So it's, making sure. So yes to interviewing lenders, and yes to interviewing your real estate agent, right? You want the most knowledgeable person, because even your real estate agent can, if I see any red flags with my client's lender per se, because it's like any profession, right? There's bad real estate agents, there's bad attorneys. I'm married to one, I can say that. And there's probably bad lenders. I've worked with one or two, but so it's just making sure that you interview them, that you're comfortable with them, and you feel that they're knowledgeable, because there is a lot out there.
Okay. One of the questions came from Crystal. She said, are the programs based on the area, I guess, that you're looking at to buy the home? Do the offers
Some are and some
differ
aren't.
sometimes if you're looking, for instance, in Lafayette Square versus looking in University City?
So some programs are and some programs aren't. So specific to the Missouri, and that's a state program. I'll just stay on that one for a while. They have a couple different programs, but some are income based, right? Some are credit score based. And so it just kind of depends. But there are even employer programs. So take WashU, for instance. They have a program called Live Where You Work. And they have a boundary. And if their employees purchase a home within those boundaries, WashU gives them, I think it's $5,000 toward, or a low interest rate. They have
almost up to 10,000 now. They've
it's up to
increased the program
10,000.
up to 10,000. Yes. Yeah.
And I have a client in that program, and she told me that they're expanding that. And so
Right.
parts of U City fall into that WashU program, and parts of U City fall into the Missouri program as well.
Yeah, the MHCC program, I think Cindy did a good job as far as laying the programs out there. MHCC is one of the most popular ones, and they have the different programs that she related to. But what I like about them, they kind of give you the options where you can get a low interest rate, or if you need help with down payment, the DPA side of it and everything, they can give you up to 4% cash assistance that can be used for closing costs or down payment. So if you're a little short on funds, the rate's a little bit higher, but you get the 4% assistance from that standpoint. And obviously, Missouri, it's statewide, but as Cindy said, there's certain areas that they call targeted areas where they have an even more aggressive interest rates and things of that nature, and higher loan limits and higher income limits, because as she said, they are income driven. Income driven. The max I think is like 481,000 for MHCC, and the income is up in the six-figure range. So they're pretty lucrative and everything. Looking at that way, but they are income driven, and sales price driven, as she said, and along those lines. But I like the program because it helps you with the lower interest rate, but it also can help you with down payment assistance. And the 3 years, people say, well, I gotta be first time homeowners. It's 3 years. If it's been 3 years and everything, then you still qualify as a first time home buyer. The other program that I'd like to mention as far as down payment assistance is Beyond Housing, which is a St. Louis County nonprofit, and they offer down payment assistance as much as $5,000, $6,000, $7,000 as far as to use for down payment, as far as closing costs or down payment. They have some income limits and sales price limits. Ironically, they don't do it in the city, but they do St. Louis County, St. Charles County, Jefferson County, and O'Fallon, Missouri. But that's a very, very good program also to help out with down payment assistance. Maybe to your point, I think that you always want to look, obviously, the best deal. Unfortunately, there's not, one website say, okay, I'm going to compare these three lenders and what do they got, what do they offer and everything. So I always suggest, as Cindy said, when you're interviewing, whether realtor or lender, talk to three different ones. I think you can get a pretty good crossbend from three. If you get more than three, then it gets confusing. It's like, Cindy takes you out to show you houses. You see more than 5 or 6 houses. You kind of, well, is that kitchen in this house or was that basement over here? And you get kind of confused what you looked at. So if you get three and you get kind of a sheet and say, okay, what was the rate? What was the fees? What was our closing time? How fast can they close? How busy they are? And just do an analysis of those three different lenders. And, when it comes to kind of CRA lending, community reinvestment, I think everybody kind of works together. And as I said about credit unions, if there's a better deal out there, we're going to tell you that there's a better deal. So a lot of the local banks do have some good programs on it. And they're going to have some programs because they have CRA lending that a credit union or a mortgage broker doesn't have. They're a little bit more aggressive when it comes to down payment assistance and specialty type programs. Being a bank, there are certain requirements of lending where they have to lend within certain zip codes, and that's, again, community reinvestment. You have to give back into the community, where mortgage brokers don't have those requirements because they don't have a deposit institution. So that's where a bank is going to be more lucrative for lending in that respect.
All right, I have a question for both of you, if that's
Okay.
From your experience, and you're talking to a new homeowner, and they have the money for the down payment and closing costs. Is there a ratio or percentage that you would tell that new home buyer to save for contingency? Like, I don't know, something happens unfortunately with the ceiling or the water heater. Is there some, when they're taking a loan out, is there any counseling that says, hey, put up 4% or 3% of just, so you won't have any issue? I didn't know if there was any experience in that.
My experience has been is like the monthly payments. And most of the guidelines say that if you could have a 6-month reserve of your mortgage payment, if you that's a good cushion for you. Obviously, if you've got a major expense or air conditioner or something goes out, tough to do that. But if you have a 6-month cushion of your mortgage payment, PITI, then you're in pretty good shape from a standpoint from there.
Great.
The other
That's good
thing
information.
I would just also recommend in this, there are home warranty programs, and sometimes they get a bad rap. We work with, and you'll probably see their commercials on TV because I see them, American Home Shield. And we just happen to have a really good relationship with them and find that they have good coverage and a good program. And if our clients ever have issues, like I was talking to the local office manager today, and I have a client that has a home warranty, and he had an issue, and so I connected him with the manager. But it even starts with, I have a client who's closing next week, and they have a home warranty that was provided with their purchase, and American Home Shield provides rekeying. So on day one, their new home will be rekeyed. And so they're already getting a benefit from there, but it covers everything from electric, your appliances. They have add-ons like roof leakage. And so it's pretty good. Even a lot of agents in our office have a warranty program on their home. So it kind of helps cover you, especially when you're a first-time home buyer.
Thanks, Cindy.
So are there any other questions from any of our participants tonight? If not, then I want to thank both Bill Bruce and Cindy Theory for being with us this evening and giving us this information. Also want to remind you, you see on this final screen, there is a QR code. If you wish to register for the last session in the series on November 9, Eric Mitchell is going to come and talk about seasonal home maintenance issues. Kind of tying in a little bit with what Mike said, is we have to be ready when all this work to get in our home, and then we have to be ready to maintain that home as much as we possibly can so that our investment continues to grow. So we have to be prepared for that as well, especially if you've been a renter where if there was a problem, you simply call the landlord. You need to be prepared for that as well. So if you use that QR code, it'll take you right to the registration form. You must register, and then you'll be reminded a day or two ahead of this last session, and then about an hour before, and then a few minutes before to remind you to jump on the Zoom so that you don't miss this. Thank you, Bill. Thank you, Cindy. Thank you, everyone, for joining us tonight. I hope that's given you some information, and I hope that it helps guide you if you're in the process of thinking about purchasing your first home. Good night, everyone.
Thank you, Mimi.
Thank you.